Kaylee.
And I'm David.
Welcome back to our YouTube channel. Today we're going to be discussing credit and your credit score. David and I didn't learn about credit or credit score or how to use credit cards until after we graduated from college. We were both in a lot of student loan debt. I had tried to get a car and I had no credit history. So we want to talk to you about why it's important to have credit cards, to know how to use them, and what is in your credit report and what they're analyzing. So what is credit and why does it matter? When people talk about credit, they're analyzing how you handle your money, what kind of loans you have, and what is your history with money. Your credit score ranges from poor to excellent, and the range is usually from about 300 all the way to 850. It helps predict how likely you are to pay back a loan when it is due. It matters for things like when you're applying for a loan. Think car loans, mortgages, credit cards, all of those things. For simplicity purposes, we're going to be focusing on FICO scores.
So the 5 factors that make up your credit score are payment history, credit utilization, length of credit, new credit, and credit mix. The most important factor of the 5 is your payment history. This makes up 35% of your credit score.
FICO keeps an eye on your revolving credit. So this is like your loans that you pay each month. Think of your student loans, credit cards, your mortgage. They're analyzing your long-term behavior. So are you paying on time? Are you paying over the minimum? Those sort of things.
The next factor is your credit utilization. This makes up 30% of your score. And this is saying how much credit are you using out of your available balance. I use 2 staple rules. Don't use more than 1/3 of your available credit balance. For instance, if your credit maximum is $900, only use $300 of that $900. The other staple rule is I don't use more credit than I have cash to pay for. For example, if I spend $300 on my credit card, I want to make sure I have the cash to pay that off directly.
The third thing is the length of your credit. This takes up 15% of your credit score, and it just lets them know how long your accounts have been open for. You can still have good credit with a short history, but it gets better as time goes on. The 4th thing is new credit, and the 5th thing is credit mix. So those are just the different loans that you're taking out and what is the variety of loans that you have. So when companies pull your credit report, they'll be able to see all of these things. The type of loans that you have out, if you pay on time or late, the amount of loans that you have. They will analyze and take all this information in and decide if they want to loan to you. The 2 main reasons why having a good credit score is important is 1, because it allows you to get the loan, but the other important reason is because it determines your interest rate. The lower interest rate, the better. If you have a better credit score, the better interest rate you'll get. I also want to quickly go over how to use a credit card correctly so that you'll get paid by using the credit card and you will not pay the bank to use the credit card. The first thing is choosing the correct credit card. You'll want to pick a credit card with no annual fees and with good rewards. Banks rely on the fact that people don't know how to use credit cards correctly. A lot of people use credit cards to spend on luxurious things instead of spending on things they just spend their cash on. Credit cards are not meant to be spent on things that you cannot afford, so don't fall into that trap. So let's say you picked out a credit card with these rewards. This reward says you get 1.5% cash back on every purchase every day. This is a real credit card. Now what you do is you use this credit card for stuff you already pay cash with. So instead of paying cash for your groceries, pay with this credit card. Once you're done grocery shopping, go to your car and pay off the credit card in full. So let's say you spent $100 on grocery shopping and you paid with your credit card. You will get 1.5% back of that $100. That is $1.50 for using the credit card and shopping. Now, the most important component of this is that you pay off the credit card before the end of the cycle because the bank charges a high interest fee. That interest fee will cost more than the benefit of the reward. So if your credit card interest has 15.99% APR, if you don't pay your $100 groceries before the end of the billing cycle, then you will get charged interest. Here's a quick example to understand how the interest rate would affect your daily balance.
Okay, wrapping this up, you want to use a credit card to make you more money. Don't spend on things you can't afford and pay the total before the end of the cycle to avoid the bank interest. Now, back to the credit score. If you have bad credit or no credit, here are some ways to increase your credit. 1, you can pay down your debts. 2, you can get a credit card and use it the correct way. 3, you can pay more of the minimum payment owed, even if it's $5 more. 4, aim for 30% utilization or less. 5, limit your hard inquiries. And 6, consolidate your debt.
There are a couple free ways to track your credit. One, we use Credit Karma. Another thing, do you have the right every year to receive a free credit report from the credit bureau? We're going to put the link to the website, and we're also going to put the phone number to where you can receive your free copy every year. They recommend to stagger the requests throughout the 3 different credit bureaus.
Thank you for watching. We hope this video helped you understand credit and your credit score a little bit more.
Make sure you like and subscribe, and then put in the comments anything else that you would like us to go over.